Hey everybody, it's Eddie from Tokyo. This is your cryptocurrency update from Japan, and these were the numbers in the mid-afternoon here in Japan, and it's dipped even further. The entire crypto global market has lost more than 12%. It is hovering around 1.8 trillion, and there's some heavy losses. We've got Bitcoin trading just above 50,000. We had Uniswap off 24% in the last 24 hours, near Protocol off 25%, Ordi off 25.9%, Arbitrum off 26.19%, Aave off 26.4%, Chainlink off 26.8%, and Jasmy off 30%. There are a few that held on a little bit more with stability. That would have been Tron, off just 6%, Monero and Zcash, the privacy coins, off 6% and 13% respectively, and Flare off 14%. XRP has lost 18% in the last 24 hours at the time of this recording. Bitcoin did come off its low, but it's still very volatile. I bought some Bitcoin, XDC, and Flare today, and yes, I'm going to cost average in, even if it's going up or down. It's what I've been doing since 2014. What do you see here? A lot of green today in Japan, and it means losses. Yes, it's opposite, like so many things are, which is a conversation for another day. Since there's no international rule, Japan just does its own thing. It wasn't so pretty. The Nikkei lost 12%, logging in its worst two-day decline in history. Crypto, yes, many of the top 100 were off their lows this afternoon, moving north, but it has retraced. Dow futures have slid 600 plus points. The S&P and the NASDAQ correction, 2.8 and 4.9 respectively. The crypto market is pretty much connected to traditional markets, and even gold and silver right now are off. So what is really spooking the market? Well, $2.5 billion is spent daily on interest to maintain our debt. That is really a crazy number. The employment market has a big red flag. It is ticked up now to 4.3%. So the U.S. economy is slowing, and it's slowing in a rate that is a little too fast. Gig employment, those side jobs that people take, are showing that not only second jobs, but there are third jobs increasing. Goldman Sachs says that it's raising its percentage from 15 to 25% chance that we're going to enter a recession. And because Jay Powell made a strong indication that the September rate is going to be lowered, it officially signals the Fed is going to take action, further pointing to an economy hitting the wall. The VIX was at 57. It has risen to 58. When the VIX, or the volatility index, goes up, uncertainty increases. So when that's present, you should expect larger price swings. I'm going to play a short clip for you so you can get an idea of what we might expect from the Fed. It looks like it's going to be a severe cut coming up, maybe 2 in a row, according to Jeremy Siegel. He's the Wharton School Professor Emeritus of Finance, along with the chief economist at WisdomTree.
We've talked about quite a bit. It was down in the low teens, up 26 points a day. It's been over 50 at one point, 49.80. And earlier, Tom Lee said when we see the VIX peak and maybe come down a little, that could indicate some type of bottoming. Joining us now is Jeremy Siegel, Professor Emeritus of Finance at University of Pennsylvania's Wharton School of Business, Chief Economist at WisdomTree. Jeremy, I hate, you probably aren't happy to say I told you so either, given what we're witnessing. But you thought the Fed was staying at, once again, for the second time, staying at the party too long and too restrictive.
Absolutely. And, this may surprise people. I'm calling for 75 basis point emergency cut in the Fed funds rate with another 75 basis point cut indicated for next month at the September meeting. And that's minimum. The Fed funds rate right now should be somewhere between 3.5% and 4%. Let me give you very simple logic of my position here. At the June meeting, the Fed has said that the long run Fed funds rate, when inflation reached 2% and unemployment has come up to 4.2%, should be 2.8. That's the normal. 2.8 is the normal Fed funds rate. Well, on Friday, we blew across the employment number. We're at 4.3. That even argues for a lower one. Now, as far as inflation, we're at 2.5%. We've gone down 90% towards the target on the inflation rate. We've overshot the target on the employment. Those are the two targets explicitly mentioned by the Federal Reserve. All right, and how much have we moved the Fed funds rate? 0. That makes absolutely no sense whatsoever.
And where does money go in times like this? Well, usually into the Treasury bills. And there's a first out there with tokenized US T-bills. They received an A rating from Moody, and Ripple is going in big. $10 million to mint these T-bills on the XRP Ledger with OpenEden. Follow the money. Berkshire's Cashpile rises to a record $276 billion. $234 billion of that is in Treasury bills. Buffett has been a longtime fan of Treasuries, calling them the safest investment there is. I've got a concise and very rich clip from the co-founder of OpenEden. I think if you listen, you're going to understand exactly what they are doing.
I'm Jeremy. Nice to meet you all. I'm co-founder together with my partner, Eugene of OpenEden. And prior to OpenEden, I was the head of Asia for Gemini Exchange out of Singapore. And before that, I spent 20 years in investment banking, in the likes of Goldman Sachs and Morgan Stanley, primarily in the fixed income derivative space. So we're very happy to be here to present to you our new launch. Essentially, we have taken US Treasury bills on chain. And the way we do that is very different, I think, from quite a number of platforms out there. So number one, we bring you direct exposure to US Treasuries instead of through a ETF and the likes. And we are the first true smart contract board that allows our investors to directly connect their wallet and mint our T-bill token instantaneously 24/7. And we created a product that is bankruptcy remote. There's no counterparty risk except for the US government. That is the only counterparty risk that our investors are facing. So this is our dashboard. It's very simple. So you can see that we have a TVL of about 12.5 million. We went live about 4 weeks ago, and you will see that the estimated yield of the current Treasury bills portfolio is close to 5.2%. So the US has been raising interest rate since last year, and now the risk-free rate, we call it, which is basically the US government debt credit rating, is paying you over 5%. And that's clearly very high in this environment. So for a user that is being KYC'd, you can just connect your wallet. So we support MetaMask, Wallet Connect, Genesis Save, and Coinbase Wallet. So I'll connect to my own MetaMask wallet. So if you look on the right-hand side, this is the panel where you can deposit and withdraw. So it's very user-friendly, it's very DeFi-centric. For example, if I want to deposit $100,000 USDC, I will receive about 99,300 of a T-bill. And when I click deposit, then it will go straight into your wallet. It is a registered fund as a token issuer, so we require KYC, and it's offered to accredited investors and professional investors across both US, Europe, Asia, so any country that's not sanctioned by OFAC. And Jerry Lee has a question in terms of what would happen to the T-bill token if USDC DPAC. Great question. So our token is denominated in US dollar. So which means to say, if USDC DPAC, then the token price in USDC will go up. So in fact, just a couple of days ago, when USDC dropped by about, say, 3 basis points to 0.99997, the T-bill token price in USDC will increase by 3 basis points as well. So we basically use the Chainlink Oracle on USDC price to price the token in USDC. But because the majority of the asset is held in off-chain US dollar asset in US government bonds, so it is pretty much a US dollar denominated token. So not only T-bill token can help you generate yield for your idle stable coin, it can also help you hedge out your USDC DPAC risk or any stablecoin DPAC risk. The minimum USDC amount, so the initial investment amount is 100,000, and subsequent addition can be in blocks of 10,000. We're built on an Ethereum, and we will be working on cross-chain in our version 2, so stay tuned.